Imagine an airline so efficient, its rivals thought it was bending the very rules of aviation itself. A few years ago, this airline was at the center of every headline, not because it was the biggest, but because it was rewriting what it meant to run a profitable airline in India.
IndiGo, India's largest airline, remains undeterred by challenges as it continues its expansion spree.
The 500 crore aircraft order that IndiGo has given with Airbus is the single largest aircraft purchase that we have seen so far in the aviation history now.
If we want to compete and bring India to the global stage, we need airlines matching that size, and IndiGo clearly is going to be one of them. We're going to double in size in the next couple of years. Today we have a little over 400 aircraft and we have another 950 on order. So that's sort of the growth trajectory we're in.
People call India the graveyard of airlines, and for a good reason. One by one, carriers have soared into the sky only to crash back to earth, leaving behind dreams, debt, and grounded fleets. In a country where over 20 airlines have shut down since the 1990s, why do new airlines keep risking it all? Is the Indian aviation market cursed, or is there a deeper pattern behind all these failures?
Capacity and low fares may be excellent for users, but aviation companies are bleeding. So who are the key players? IndiGo and Jet Airlines until it started struggling to fly. IndiGo's profit fell nearly 97% in the last quarter of 2018.
Jet Airways suspended operations on April 17, 2019.
Many passengers who have been stuck because of their flights have been cancelled as they have booked their flight with Go Airlines that was founded by billionaire Nusli Wadia, which is now filed for bankruptcy.
Amid this firestorm of bankruptcies, there was one airline that stood apart, and that is IndiGo Airlines. Take a look at this. While Jet Airways was sinking under a massive loss of 1,814 crore rupees and SpiceJet was battling a loss of 687 crore rupees, IndiGo was flying high with a remarkable profit of 1,300 crore rupees. It wasn't just surviving, it was dominating the skies with an incredible 60% market share. But on October 25, 2024, IndiGo dropped a bombshell. The airline's latest quarterly report stunned everyone. IndiGo was now staring at a massive loss.
Interglobe Aviation, the parent company of India's largest airline, IndiGo, has reported a significant net loss of around $120 million for the recent quarter. That marks a stark reversal from the previous year's profit.
If you look at this chart, you can see that their expenses suddenly shoot up by about 3,000 crores rupees. And that is where the trouble begins. Their profits take a brutal hit, crashing from 189 crores in the green to a painful loss of 987 crore rupees. So now, the same airline that once set the gold standard for profitability in India finds itself caught in financial turbulence, just like everyone else. So the big question is, what went wrong? To find the answer, detailed research reports were dug into to figure out how IndiGo, the once legendary airline, is suddenly struggling to stay profitable. What are the market forces and conditions that are draining the lifeblood of what many call the greatest airline in Indian history? And if even IndiGo is finding it hard to stay in the air, what does that say about the future of Indian aviation itself? Are we moving towards a future where India might not have a single consistently profitable airline at all? Now, to understand why IndiGo is running losses, we first need to look at some key metrics that define how the airline business actually works. The first one is called RASK, or Revenue Per Available Seat Per Kilometer. In simple terms, RASK tells you how much money the airline earns from one seat for every kilometer flown. If we look at IndiGo's numbers, its RASK has actually gone up from 4.25 rupees in September 23 to 4.45 rupees in September 24. Next come an equally important metric, the load factor. This represents how efficiently an airline is filling its available seats. Think of it this way. If an IndiGo flight has 200 seats and 150 of them are filled, then the load factor is 75%. That means 75% of the seats are occupied while 25% are empty. Now let's compare this with other airlines in India. In September 24, Air India recorded a load factor of 80.1%, SpiceJet was at 80.4%, Akasha Air had the highest at 85.7%, while IndiGo reported a load factor of 82.6%. If you look at IndiGo's revenue from Q2 FY24 to Q2 FY25, it's clear that things are moving up. Their revenue jumped from 15,502 crore to 17,599 crore rupees. So, on the surface, everything seems great for IndiGo, right? The revenue per seat per kilometer is rising, the load factor is strong, meaning the airline is operating at peak efficiency, and even the overall revenue growth looks impressive. But then comes the big question. If everything looks this good, what exactly went wrong? How did IndiGo expenses suddenly shoot up by 3,000 crore rupees, turning what seemed like a solid quarter into a loss of 900 crore rupees? That's where the real story begins. There are three main reasons behind IndiGo's slowdown in Q2 FY25, and each one tells us a very interesting story about how even the biggest airline in India can hit turbulence. Let's understand these reasons one by one. The first reason is one that every airline in the world struggles with: the volatile fuel cost. Did you know that fuel is actually one of the biggest expenses for any airline? It makes up to 35 to 40% of their total spending. And this is exactly where IndiGo got caught in a trap. Here's how. If we look at how unstable oil prices have been, in July 2023, crude oil was around $70 per barrel. But in just 4 months, by October, it shot up to $95 per barrel, and then by January, it dropped again to $70 per barrel. So within roughly 90 to 120 days, oil prices swung almost 30%, directly pushing up airlines' cost. For IndiGo, fuel accounts for 37.19% of its total revenue, while its net profit margin stands at 11.5%. Now, let's break this down with a simple example. Suppose you book a Mumbai to Chandigarh flight for rupees 10,000 15 days in advance. Out of that 10,000, about 3,719 goes towards fuel and 1,150 rupees is IndiGo's profit margin. But because of global factors like the Russia-Ukraine war, if oil prices suddenly shoot up from $70 to $100 per barrel within a month, IndiGo's fuel cost on that same ticket rises from 3,700 rupees to 5,000 rupees. That extra 1,300 rupees in fuel expenses completely wipes out the 1,150 rupees profit, leaving the airline not just with zero profit but actually in loss. So just because oil prices spiked due to a conflict halfway across the world, IndiGo's entire margin can vanish into thin air. Now, you might be thinking, hey, airlines can just factor in these oil price variations and set their fares accordingly, right? Well, yes, they can. But here's the catch. Oil prices are insanely volatile. Serving a price-sensitive market like India while trying to keep some extra margin for fuel cost is super challenging. Even if you hike your ticket price by just rupees 500, customer might just stop flying with you. IndiGo prides itself as a low-cost carrier, so passing on rising costs directly to passenger is almost impossible. If you dig into IndiGo's 2024 financials, you will notice their fuel expenses shot up by 12.8%, jumping from 5,856 crores in September 2023 to 6,605 crore in September 2025. This spike in fuel cost is seriously eating into their profit margin, and that's the first big reason behind their losses. Now coming to the second reason, that is grounded airplanes and operational headaches. The entire Indian aviation market got hit hard because of those Pratt & Whitney engine issues. In September 24, Go first announced that Pratt & Whitney supplied faulty engines which forced them to ground planes. The operational disruption caused direct massive losses for the airline.
Fortunately, Pratt & Whitney The engine manufacturer has completely deceived us. It's been a horrible story for last 3 years.
Pratt & Whitney is among the top 3 aircraft engine manufacturers in the world. Of late, it has been in the news for complaints of faulty engines from both aircraft manufacturers and the airlines. India's biggest commercial airline, IndiGo, has already grounded around 33 planes because of pending maintenance and shortage of spare parts from P&W.
This is an issue with the engine breaking, and as a result of it breaking, you cannot supply a replacement engine. The point is, engines are breaking, engines are falling apart, and we are seeing emergency landings. Now, thank your stars, we have not seen a crash as a result of Pratt & Whitney in India, either with IndiGo or with Go Air.
At one point in Q1 FY25, over 70 of IndiGo's planes were just sitting idle on the ground, not flying, not earning, just stuck. Now that might sound like a simple operational hiccup, but let's see how costly this really is. In FY25, IndiGo generated a whopping 84,982 crore rupees of revenue with a fleet size of around 434 aircraft. So if you break that down, each aircraft brings in roughly 196 crore rupees in revenue every year. That means those 70 parked planes could have together earned IndiGo nearly 13,700 crore rupees in revenue. So while those planes were grounded, IndiGo was literally bleeding revenues worth over 13,000 crore. To keep things moving and continue serving passengers, IndiGo decided to temporarily lease planes, but this wasn't your regular lease. This special type is called ACMI, which stands for Aircraft Crew Maintenance and Insurance. Under ACMI, IndiGo basically rents not just the plane but also the crew and the maintenance support. It's like renting a complete flying service solution to fill the gap quickly. But here is the catch. This move came at a cost. Because of the emergency leases maintenance of grounded aircraft and these pricey ACMI deals, IndiGo's lease expenses skyrocketed by 180%. Their lease cost shot up from 10,752 crore rupees in FY24 to 30,103 crore rupees in FY25, a massive jump. And that's not all. Along with this, IndiGo's rental and repair cost also rose by about 15%, adding to this pressure. Thirdly, their non-fuel operating expenses, things like parking fees, ground handling charges, landing fees, navigation fees, terminal service charges, and passenger service fees have shot up too. Airport charges, especially at major airports like Mumbai, Bengaluru, Hyderabad, Chennai, and Kochi, have increased anywhere between 2% to 200% this year. All in all, IndiGo's airport-related costs alone have surged by 24% year over year between FY24 to FY25. These multiple challenges, grounded planes, expensive leases, higher airport charges, volatile fuel cost, have pushed IndiGo into massive losses. And it's not just IndiGo. All airlines in India are facing similar turbulence right now. But here is the silver lining. IndiGo isn't sitting idle. The airline is already gearing up for a strong recovery and long-term growth, preparing its fleet, finances, and strategy to bounce back stronger than ever. You know what's crazy? For the first time ever, IndiGo, the airline that built its empire on being a low-cost carrier, has decided to break its own rule. They have actually introduced a business class cabin on the Delhi-Mumbai route. That's huge shift, almost unthinkable for a brand that's always prided itself on being simple, efficient, and affordable. But there's more to this story. With the competition heating up in India's domestic skies, IndiGo has now set its eyes beyond our borders. They are rapidly expanding internationally, adding new routes to destinations like Sri Lanka, Malaysia, Hong Kong, in a push to diversify and boost their revenue streams. And to strengthen customer loyalty, IndiGo has launched something new, a loyalty program called Blue Chip. The goal? Keep passengers coming back again and again, especially in a time when price competition is so intense. But Despite all these new moves, IndiGo is still bleeding with losses. And that brings us to a much bigger question, something every Indian aviation fan and business enthusiast should think about. If the most efficient airline in Indian history, IndiGo, is struggling to stay profitable, does it even make sense to run an airline business in India? Think about it. Even with 71,000 crore rupees in revenue in FY24, the company operates on a razor-thin margin of just 11.7%. And that margin can vanish overnight just because of a sudden war, rising oil prices, or a global recession. To make things worse, as an airline grows bigger, its business risk grows too. So then the question is, why are brands like Tata, IndiGo and Akasha still betting big on Indian skies? Well, the optimists have one simple answer. India is a massive growth story. The demand of air travel is expected to rise dramatically as the middle class expands and international travel is already booming. Just look at this. In 2025, India's aviation market stands at $14.78 billion and it is expected to grow to $26.08 billion by 2030 at a CAGR of nearly 12%. India has already surpassed Brazil and Indonesia to become the third largest domestic aviation market in the world, right behind China and US. Currently, we have around 15.5 million airline seats compared to China's 67.8 million and America's 86.1 million seats. So clearly the room for growth is massive and it's a huge potential. This promise of scale and opportunity that's making aviation brands so bullish on India. And it's this huge potential, this promise of scale and opportunity that's making aviation brands so bullish on India. But here is the catch. If India wants this growth story to actually take off, there are three big challenges we need to address. Number one, we need more airports, plain and simple. Number two, India must increase per capita income by creating more jobs and attracting foreign investments so that flying becomes affordable for more people. And number three, the government has to make doing business easier for airlines, because without the support of these airlines, India's dream of becoming a global aviation hub could slow down dramatically. So if you have made it till here, I hope you learned something valuable about how the entire Indian aviation market operates, the challenges, opportunity, and the real economics behind those ticket prices. That's all from my side for today. If you found this breakdown valuable, please hit the like button and subscribe so you don't miss out on more such insightful business case studies. Thank you so much for watching and I'll see you in the next one. Thank you. Bye-bye.